Hello, five-star real estate agents, and welcome to another Deal Doctor live stream episode. Hello, five-star real estate agents, and welcome to another Deal Doctor live stream episode. I'm Eric Graham, and the topic today is on commercial real estate basics. Now, we often get calls from agents that say, "Hey, how do I get into commercial real estate?" Well, I have to say, how did you get into residential real estate? I bet that you took classes, a pre-licensure class. I bet that you studied. You passed an exam, and you probably even had a friend or a mentor help you understand the listing and buying process and contracts. Oh yeah, and I bet you spent a lot of time and money to educate yourself. So if you're thinking about getting into commercial real estate, then it's going to cost you time and money. Commercial real estate is completely different than residential, and it requires an agent to understand certain economic principles, math calculations, and investment principles. Now, let's discuss the classifications of real estate and what are they. So typically, when people want to know about commercial real estate and the classifications, commercial real estate is typically when we're looking at properties, they're classified by age and quality. As either a Class A, which is a newer building with high quality infrastructure and location, Class B, which could be slightly older and less appealing, and a Class C building, which these are buildings at least 20 years old and in need of maintenance. Now, these classes are used to inform real estate investors about the state and value of their investment properties. Now, commercial property versus residential property. What's the difference? Well, an overview of the differences between residential and commercial could be stated such as this. 1. Purpose. Commercial real estate spaces are built specifically to generate income for the lessee or the investor. Though owners of a single-family residence can lease their home to generate income, the primary purpose of residential property, like a condo or a single-family home or townhouse, is for a person or family to live in. Now, occupancy. Well, large apartment buildings and high-rise residential buildings with more than 5 units are considered commercial buildings classified as multifamily properties. Any residential building with 1 to 4 rental units as part of the property, including single-family homes, are considered residential real estate. What are the differences between commercial and residential with regards to leases? Well, the lease length, so commercial real estate leases are generally for 5 to 10 years or more, meaning they are generally longer than a residential, which typically is an annual lease year to year. And what about rates? Well, commercial real estate prices are typically reported as a valuation calculated by the valuation of the square footage of a property, whereas residential real estate properties are typically priced as the annual sum of monthly rent. Now, there are 8 types of commercial real estate. These are not all inclusive, but in general, these are the 8 categories that we see for commercial real estate. 1 is office space. Now, office spaces include all office buildings with workspaces that are available for rent for different businesses to operate out of. Number 2 would be industrial space. Now, industrial real estate is any real estate used for the purpose of industry, including heavy manufacturing, light assembly, bulk warehouses, and flex spaces that can mix industrial space with office space. Number 3, a multifamily complex. Now, multifamily properties are residential rental properties with more than 5 units, like apartment complexes, that are considered commercial space they're considered commercial space because they generate rental income for the property owner or property management company. 4th type of commercial real estate is retail spaces. So retail properties are any buildings used for retail purposes. This can be anything from single storefronts to strip malls and shopping centers. Larger properties such as malls will typically have an anchor tenant, which is a larger department store that will draw other retailers to the property. 5th category would be hotels. Now, hotels are divided into 3 different categories. You have full-service hotels or large multi-room hotels with at least one bar or restaurant. You have limited service hotels, which are smaller, more bare-bones hotels that may not offer services like concierge or 24-hour desk services or turndowns. And then you have extended stay hotels that offer larger rooms, which are more similar to serviced apartments. Number 6 would be mixed-use properties. Now, mixed-use properties are typically any combination of the above categories. Common examples of mixed-use properties are multifamily, apartment buildings with retail spaces on the ground floor. Land. Land includes farmland, agricultural, real estate, vacant land, or brownfield land that was previously used for industrial or commercial purposes and is now available for reuse. And an 8th category that we typically will put things into is what's known as special purpose. Special purpose real estate includes commercial properties such as amusement parks, theaters, zoos, parking lots, and any type of commercial property that does not fit into the above categories would be considered special purpose. Now, there are 4 types of commercial leases. Now, there are actually probably 12, but the 4 that, or actually I'm going to classify 5 right now that I want to go through, are that they all have to deal with very similar terms, but the difference might deal with who's paying the taxes or who's paying the insurance for these. So, for example, a single net lease makes the tenant responsible for paying all property taxes for the duration of the lease. Now, a double net is going to deal with 2 categories that the tenant's going to pay for. The double net lease makes the tenant responsible for paying the insurance and property taxes. And then the triple net is going to deal with 3 categories that the tenant's going to pay for. And in a triple net lease, the tenant's responsible for paying insurance, maintenance, and property taxes for the duration of the lease. So, in essence, the tenant pays everything, and the landlord will just pay the mortgage. A gross lease, you might hear a term gross lease. In a gross lease, the tenant only pays the rent, and the landlord pays all other related fees for the property. Some people will see a modified gross lease. Now, that's where the tenant and landlord will split certain expenses associated with that. So, the next category that in basics for real estate that I want to get into are some common terms that anyone who is in or wants to pursue commercial real estate will need to know. But in commercial real estate, there are so many courses out there, and I've always encouraged agents to go online, go into Google, do some search. There's a Florida Institute of Technology that you can enroll with to get a master's in science of real estate. I didn't even know this was available. It's like a 10 to 12 month course. There are other courses in commercial real estate that you may only spend 3 to 5 hours a day doing for 3 months. There's NAR, the National Association of Realtors, that you can go on and look up courses for commercial real estate basics. There's the CCIM that you can go. That's a designation for people who are truly involved, and there's very few. There's only a few thousand throughout the U.S. that have that designation, or I should say internationally, it might only be like 10,000. But that's a very unique type of program for commercial investment real estate agents, where you end up diving into a lot of the principles of understanding risk analysis for your investor, meaning you're going to look at this building, you're going to verify whether it's a sound investment for the client, and you're going to provide them with documentation or a pro forma which will forecast out all of the income that's coming in from that building or potential income, all of the potential expenses, and then you're going to be able to look at their net operating income and then determining whether if someone were to purchase that building, can they service the debt? I mean, anyone can go buy a building. It's just the problem is the income that's coming in. Is it enough income for you to also service the mortgage or the debt without So people say, well, what do I need to know about commercial real estate? And a lot of it comes down to vocabulary. It comes down to understanding the language that's out there and certain basic business principles. And some of these that we look at for common real estate terms that you must know before you get into making any type of commercial real estate investment decision. And one, the biggest one, is what people want to know is the net operating income, or NOI. So net operating income is determined by rental incomes minus expenses. So those expenses do not include mortgage payments or depreciation, but specifically property expenses. So NOI, which is net operating income, is at the heart of every commercial real estate deal you'll ever evaluate. It will determine the property worth now and in the future. Oh, so no one can hear me. Oh my goodness. All right, let me try something else here, folks. Thank you for letting me be aware. How about now? Is everyone, can people hear me and give me a thumbs up? I can't hear either. Okay. Well, bear with me, folks. All right, we're going to try something else here. Sorry, folks. I'm not sure why my speaker is not working. Uh, and this session will be available at a later time and recorded for your use. Sorry for the Well, folks, what we're going to do is we're going to cancel this session. I'm going to do an actual live session of this, and we're going to put it up for everyone's enjoyment. I don't understand why this isn't working, but I will redo all of this for everyone. I'm going to make a note of this here. I'm going to log off this session, and we'll create this live stream session again. And I apologize, folks. I am very sorry. But thank you. I don't know if anyone can still hear me. I don't better now or not. If don't know if there's a thumbs up here. I can hear you better now. Some people are saying, but I guess I can try going through again. My audio all the way up here. So I don't know. Is that any better, folks? Better? Okay. Well, let me start over then. I apologize. All right. Hello, 5-star agents, and welcome to another Deal Doctor live session. Our topic today is going to be the basics of commercial real estate. And many agents will call up and ask, well, hey, how do I get in commercial real estate? Well, how did you get into residential real estate is the question, right? I bet it took a lot of you. See, I can hear a little, but just talk loud. I am talking loud. I'll try to scream, I guess, if I have to. So many agents will call and ask, how did you get into real estate? Well, you took a pre-licensure exam, you studied, you passed, you probably had friends and mentors help you as well, review and understand listing and the buying process. And oh yeah, you spent a lot of time and money to get licensed and to educate yourself. So if you're thinking about getting into commercial real estate, then it's going to cost you time and money. Now, commercial real estate is completely different than residential, and it requires an agent to understand certain economic principles, math calculations, and investment principles. So let's discuss the classification of real estate. And what I have here, again, this is just the basics of commercial real estate. Commercial real estate is classified typically by age and quality as either a Class A building, which is newer buildings with high quality infrastructure and location, Class B, which are slightly older and less appealing buildings, Class C are buildings at least 20 years old and in need of improvement or maintenance. Now, these are classes that are used to inform real estate investors about the state and value of their investment properties. Now, commercial property versus residential properties. What's the difference, right? Well, one could be the purpose. Commercial real estate spaces are built specifically to generate income for the lessee or the investor. Though owners of a single-family residence can lease their home to generate income, the primary purpose of residential property, like a condo, a single-family home, or a townhouse, is for a person or family to live in it. Now, occupancy. Now, large apartment buildings and high-rise residential buildings with more than 5 units are considered commercial buildings classified as multifamily properties. Now, any residential building with 1 to 4 units or rental units as part of a property, including single-family homes, are considered residential real estate. Now, lease lengths. Commercial real estate leases are generally for 5 to 10 years or more. Now, we'll even see a lot of landlords accepting a 1-year lease, then maybe a 3-year, but in general, it could be 5 to 10 years or more, meaning they want to ensure that they have these tenants long-term compared to residential, right? It might be an annual lease. Now, rates. Now, in commercial real estate, prices are typically reported as a valuation calculated by the valuation of square footage of a property, whereas residential real estate properties are typically priced as the annual sum of monthly rent. So they are calculated slightly different. Now, there are 8 types of commercial real estate. Office space. Office spaces include all office buildings with workspaces that are available for rent for different businesses to operate out of. Another type of commercial real estate are industrial space. Industrial real estate is any real estate used for the purpose of industry, including heavy manufacturing, light assembly, bulk warehouses, and flex spaces that can be a mixed industrial space with office space. A third type would be a multifamily complexes. Now, multifamily properties are residential rental properties with more than 5 units, like apartment complexes that are considered commercial space because they generate rental income for the property owner or property management company. A fourth type of commercial real estate, retail spaces. Retail properties are buildings used for retail purposes. Now, this can be anything from single storefronts to strip malls and shopping centers, or larger properties such as malls will typically have an anchor tenant, which is a larger department store that will draw other retailers to the property. Fifth category would be hotels. Now, hotels are divided into 3 different categories. You have full-service hotels, are large multi-room hotels with at least 1 bar or restaurant. You have limited service hotels, which are smaller, maybe more bare bones hotels that may not offer services like concierge or 24-hour desk services or turn down. And then you have extended stay hotels, which offer larger rooms which are more similar to serviced apartments. Now, a sixth category would be mixed-use properties, which are very common these days. And that mixed-use properties are typically any combination of the above categories, such as multifamily apartment buildings with retail spaces on the bottom floor. Seventh type of category would be land. So land includes farmland, agricultural real estate, vacant land, or brownfield land that was previously used for industrial or commercial purposes and is available for reuse. Brownfield are typically those that are contaminated properties that the city allows investors come in and repurpose that land and maybe provide them with substantial tax benefits to do so, because the city doesn't want it to be a contaminated eyesore as well. Now, an eighth category is special purposes. Now, special purposes includes commercial properties such as amusement parks, theaters, zoos, parking lots, any type of commercial property that does not fit into the above categories would be considered special purpose. Now, I want to jump into some different types of commercial leases. People will hear a lease, a single net or triple net or gross or modified. What do those mean? Well, it's important to know what that means so that when you are representing your client in a lease for commercial property, that you know what the client is going to, or your tenant is going to be responsible for. Now, typically with leases in commercial real estate, it comes down to who is going to be paying the taxes or insurance. That's what it comes down to, and the maintenance. There's typically three things: taxes, insurance, and maintenance of the building. Now, a single net lease says that a single net lease basically makes the tenant responsible for paying all property taxes for the duration of the lease. Well, we're not going to see a single net lease typically ever, because the landlord wants more than someone just to pay for property taxes. There's a double net lease, which means that the tenant would be responsible for paying insurance and the property taxes. Doubt you're going to see one of those either. What you're typically going to see is a triple net lease, where the tenant is responsible for paying insurance, maintenance, and property taxes for the duration of the lease. In other words, the tenant pays everything. You'll probably also see a modified gross lease, is where the tenant and the landlord will split certain expenses, maybe certain common maintenance areas or certain charges they might split. But it's very important in commercial real estate that you understand vocab. Commercial real estate has so many new vocabulary words, and that you need to understand the vocab before you can start representing a client. Now, let's get into some of what these terms are. Now, in commercial real estate, there are certain terms that any agent should be aware of. One of them is net operating income. So, what is net operating income, or NOI? Now, net operating income can be determined or calculated by taking all the rental income on a property and deducting all of the expenses. Now, the expenses do not include mortgage payments or depreciation on the building. Anytime someone buys an asset or a building, we get to depreciate a certain amount of that each year over the life of that building. Typically 30 years would be what the IRS would say for a certain building, but it could be different in certain areas, but typically an asset can be depreciated. But in our formulation here for net operating income, all we would care about is understanding what the rental income is coming from that investment property minus the expenses. Now, NOI is at the heart of every commercial real estate deal you're ever going to evaluate. It will determine the property worth now and in the future. And that's important to understand. Now, it's important because as net operating income increases, the property value will increase as well. Basically meaning that if that property is generating a higher net operating income, so all the money comes in, let's say it brings in $1 million, and it has $500,000 in expenses, you're going to have a $500,000 net operating income. And the higher that net operating income value increases, the more expensive that building is going to be for someone to purchase. Now, you will learn these concepts in the basics of commercial real estate in helping investors understand whether a asset or an investment is a good deal or not, or whether they can service the debt once they buy the building. I've always said that anyone can always buy a building, but can they service the mortgage debt? And this is where commercial real estate agents will come in, and we will typically, as we advance in our knowledge of a lot of these principles and terms and calculating and doing what we know, what we call pro formas. Pro formas is basically an Excel spreadsheet that has all these calculations in it, and it does a 0 to 1 year formulation. It does a 1 to 3 years, and it could even go out to 5 years to let an investor see what the potential income could be for this asset that they're purchasing. I've been known to, unfortunately, a lot of times kill a deal because after they see the pro forma, they don't like the risk associated with what they've just learned. And like I said, I feel that so many people are able to buy buildings, but the revenue coming in doesn't allow them to continue to operate the building or business, and normally you end up seeing a failure happen in year 2 or 3. And this is why it's important for commercial real estate agents to understand certain terms and calculations and be able to do future forecasting, is what we call it, or pro formas, to let your client know. Now, a lot of agents don't do that. They just say, hey, it's not my problem, talk to your CPA or talk to whoever. But if you're a qualified real estate agent, you're going to provide some guidance to your client on whether it's a good investment or not. Ultimately, it's up to the client to make that determination, but at least you have something in writing showing that you believe it could be a good investment or it might not be a good investment. And they're going to want to know your input. And we don't guess on these things. The only thing we can do is give them solid reasoning based on what income is coming in and what expenses are going to be going out. Now, another term that we use is cash-on-cash return. Now, cash-on-cash return is also known as your return on investment, or ROI. Now, return on investment, or your ROI, is very important because it's not how much money you spend on the property, but how fast your money is coming out of the property. So if you're putting in, let's say if all you have is $50,000 to spend, and it takes 20 years to get back your $50,000 through cash flow, that's not too exciting for an investor. That's around a 5% return. Perhaps that's okay for a stockbroker, but not for us in commercial. We're expecting typically a double-digit return minimum. So instead, it would be better if you could earn back your $50,000 down payment in 3 years. So that would be a 33% return on your investment, and that's doable, and that's where a lot of investors are looking. Now, one of the biggest terms that we like to use, and you hear it all the time, and you even see it in commercial real estate, is capitalization rate, or cap rate. Now, if you look at the commercial real estate industry as a whole and are looking for a singular calculation that everyone uses in the industry, it's the cap rate. Now, some people may say it's correct and some people may say it's not, but cap rate is where it is. So it's an industry standard to use the cap rate, which is the NOI divided by the sales price. It's important to know this because the cap rate is used to measure a building's performance without considering the mortgage financing. So for example, if you paid all cash out without investment, how much does it make? What's your return? That's what a cap rate is. In layman's term, a cap rate is your return on investment if you paid all cash for the property. Now, you might see a high cap rate is 10 or 11 or 12%. Usually typifies a higher risk investment and a low sales price. In comparison, a low cap rate, such as a 4 or 5 or 6%, usually typifies a lower risk investment, but a high sales price. So every neighborhood has a cap rate. If you know what the NOI is and you know the cap rate, then you can calculate what the sales price would be. So, sales price, let's say. If the cap rate is equal to your NOI divided by the sales price, you can flip that equation over and the sales price is equal to the NOI divided by the cap rate. So, cap rates. Cap rate is equal to your net operating income divided by the sales price. So if you have a $100,000 of net operating income coming in for this project that you're looking at, and the sales price is $1 million, your net operating income of $100,000 divided by $1 million would be 10%, would be your cap rate. So cap rates are very important to understand, and we'd be happy to continue to review that as if you have questions about that. The other thing that I wanted to discuss, some differences would be price per square footage. You know, in commercial real estate, we're always looking at the price of the building divided by the square footage to understand what dollar amount it is per square foot. And another concept that's important to understand is debt coverage ratios. This is a term that we use. We call it DCR. This is a term frequently used with lenders, and the DCR needs to be over 1.0. It's another calculation that you end up learning as a commercial real estate agent to determine whether a lender will potentially lend money to purchase a certain building. So, again, I just wanted to give you some basics on commercial real estate. We encourage you to spend time. You're going to spend money on this as well. You're going to need to go online and get yourself educated in certain courses to take, and you need to start somewhere, just like you did when you started residential. We encourage you to continue to grow your business, and commercial real estate is really about knowing people. People will trust you. You can learn the process. We encourage you to get out there, spend some time and money, because that's what it's going to take. And I appreciate your time here today. If you have any other questions, you can always reach out to the Deal Doctors. Our number is 616-490-0902. Or there's always an email, eric@fivestarleaders.com. We'll be happy to answer commercial real estate questions as they come up. Again, I'm sorry for the low volume initially, but I hope this worked out for you. And enjoy the rest of your day, and thanks for tuning in. Take care.